Welcome to Selling Dallas-Fort Worth. Today we're excited. We're talking about boring stuff, market reports and advice from financial advisors that we all think we want to hear, but we never actually want to hear it because they tell us what we're doing wrong. And to join us and to tell us what we need to be doing with our money, how we need to be investing in real estate and in stocks, it's my good friend Tyler Wright with Bluegrass. Thanks for coming.
Yeah, absolutely, man. Happy to be here. Thanks for having me.
Yeah, I'm excited for it. And one thing that they do that I think is awesome, every time they start a meeting, is they get to tell us what they're grateful for. So what are you grateful for today?
Yeah, so it's called Go Big, Begin in Gratitude, and it was started by my managing partner, Kyle. But today, I'm grateful for the ability to work from home. I have a golden retriever named Arrow. He's 3 years old, and yesterday I was working from home. I was doing a meeting. I had his head resting on my foot, and I'm like, wow, there's nothing that could make me feel bad today.
Yeah.
Life is just full of roses. But that's what I was grateful for today.
That is awesome. Well, that's pretty awesome. And I'm grateful for being in a career that gives me the flexibility to be there with my family, to be able to enjoy it. If it's working from home, being able to travel and just being with them, there's nothing like it. For you, it's being able to sit there with your dog. That's amazing.
Yeah, I'll have the same thoughts when I actually have kids.
Oh, just wait. But no, so I just want to bring you in. Like, there's some interesting stuff going on in the market. When it comes to our housing market numbers, the numbers don't look that bad. But then when you take a deeper dive into them, it's like, oh, there's a lot more stuff going on behind the numbers. And you brought up something to me yesterday about the S&P 500 that just stuck with me.
Yeah.
So what's going on?
I love your analogy because you can see the cover of the book and you think you have an idea of what's going on, but then you open up the book and you start reading, you're like, what the heck? This is not what I pictured when I saw the cover. And that the same thing's going on with the S&P 500. And to provide a little bit of context, this is a benchmark in the financial world used to measure performance across the 500 largest companies. And this benchmark is currently up. I think it's changed very recently. I think I checked today, it was around 10 or 11%. That's pretty good. Yeah. But you open up the book, you start to read, and what's actually going on is there are 7 companies. It's going to be NVIDIA, Tesla, Google, Microsoft, Apple, Amazon. They're all called mega caps because they're so big. And I'm sure everyone listening at least knows who those companies are.
Yeah.
And they're all up. NVIDIA was up 200-something% year to date. Microsoft's almost up 40. Google's up 50. All of these mega caps are carrying the weight of that average. And if you actually remove those 7 from the S&P 500, we're calling it the S&P 493, the market's almost flat.
And that's pretty crazy. So we have 493 of the biggest, most successful companies in the world, especially right here in the United States, that are down or flat this year.
Yeah, it's now it's scary to think about, but those 7 have done extraordinarily well, and the rest, it's not that they're doing terrible, but there's no growth happening. All of the growth is being captured by these big companies, and there's a multitude of reasons this could be happening. Normally, when interest rates go up, investors' sentiment goes towards larger companies who have low debt, high cash reserves, so they can make it through to the other side of whatever nonsense is going on. So there's a bit going on that can be explained by things here or there, but a lot of the big companies are struggling too.
Yeah. I just saw American yesterday. They had over $400 million in third quarter losses. And you read it and it's like, well, in the third quarter, our gas didn't really go anywhere. The only thing I can correlate it to is really just our inflation numbers, and people are really hurting at home more so than what the numbers are telling us. Unemployment's really low. Our housing market here is pretty normal. It's not terrible. At least that's what our numbers look like.
Yeah.
And yet they lost $400 something million in the third quarter in the busiest time of year. And it's just wild to me.
Yeah, it makes you worry. And the scary part is unemployment is low, and a lot of these companies are unprofitable. So what is a quick way to increase your profit margins? Layoffs. Yeah. And then what follows after layoffs is lowered economic spending and a little bit of a pullback in growth in the entire economy.
Yeah.
So
what do you, if you had a little crystal ball, and I get asked this all the time about like the real estate market, yeah. And I hate the question, but if you had a crystal ball, what do you think the next 6, 12, 18 months is going to look like in the financial markets?
So thankfully, we have a lot of historical data to go off of. Now, in recent events, in 2022, 2023, a lot of the market activity has been influenced by the Federal Reserve. This is the group of, or the government organization that is in charge of fighting inflation and spurring economic activity whenever it's low. So those are their two jobs. Mm-hmm. The way they control those is by rising the federal funds interest rate, or raising, and then cutting it to spur economic activity. So they raise the rates to fight inflation, cut them to spur up economic activity.
And one thing that isn't happening in real estate, at least on paper, which is weird, it's something we talked about yesterday. We have interest rates that are right now, today, over 8% on average.
Yeah.
And we've gone from 2 weeks of inventory in 2022 to right now, Texas, we're sitting at about 3 months of inventory. Our closed sales for September was down 15%. And our average sales price for the state, only down 1%. So you have more inventory, you have almost 20% less closed deals, and our prices are holding flat on paper. And that's where I wanted to take a moment to just dive in, open the book, that cover, as you would say, because what the numbers and what our reports aren't telling people is every single listing, at least the large majority of them, are giving seller concessions of 3 to 5%. So while our median sales price might look great on paper, call it $400,000, well, there's 5% of that given to the buyer right now.
Right.
And so I'm of the belief that we're actually in a midst of a market correction in our housing. It's just right now we're covering it up with 3-2-1 buy downs, 2-1 buy downs, because it's built into the contract. And so on MLS, where people pull the data, it's like, oh yeah, the average $400,000.
But it's like, the real stories lying underneath the surface.
Yeah, it's just kind of like the S&P. You say you strip out 7 companies.
Yep. And
boom, you're zero. Well, if you actually dive into our contracts, that's what's going on. I just went under contract on a house for one of my sellers. It's $564,000, but we're contributing 6% towards closing cost. So really the net sale of that house is $533,000. But on paper, it's going to look like we sold it for $564,000. And it's just, it's really frustrating to see just everybody not really dive into the numbers. And we just keep telling everybody, oh, we're fine. We're fine. Look at the sales numbers.
Yep.
Denton County actually saw a 1% growth in September over September. but it didn't.
It didn't actually.
It didn't actually.
It just looks like it did.
But in the market report that I posted a couple days ago, it sure looks like it. And that's really, it's just crazy how what's going on in the stocks, what's going on when you're when your boots are on the ground in the real estate game.
Yeah.
It's not really what's going on.
So how do you get that message across to the people? Because this is information they need to know. They got to know what's going on.
So it's really doing this, talking about it, bringing it to light, and then really questioning the practices of our appraisers. Because right now, in my opinion, once they're a comp, I think we're doing a disservice to current home buyers and future home buyers when, if I'm selling a house for $564,000, but I'm giving away $33,000 and it's going to appraise at that $564,000, I don't think we should be appraising houses when we're paying sellers, or sellers are paying buyers to buy houses. and that's what we're transitioning into. And how it works is we've entrusted appraisers, in my opinion, to really keep hold of this market and to keep our housing bubbles from happening, right? Realtors, we're guilty of just like 2021. I mean, it was guilty. You just throw a dart on the board, it sticks, and you were getting it. Oh, and then you just
20,000 over,
and you
15.
just kept raising it, and then it's like, oh crap, these become comps. These are appraising because somebody's covering that gap with cash. But now we're in this opposite thing to where, in my opinion, we really need appraisers to start hampering down on these programs, because if I'm paying a buyer to buy a house, the house isn't worth what it is on paper.
So how do you control it? Is there an opportunity for control with the appraiser you get?
No, the appraisers are true third-party independents. Banks have a list.
That's probably for a good reason.
Yeah. And yeah, they need to be there. We're entrusting appraisers to be a true independent licensed appraiser that they have no skin in the game. They don't know the seller. They don't know the buyer. They're on a list at a specific bank or lender that is entrusting them to protect their asset. I'm just looking at it from, are we really protecting the asset if we keeping the prices inflated?
Yeah. At least report the true data.
Yeah. And it's in there in MLS. When I sell this house here next week, it's going to show how much was in that seller concession. And when we're going to set offers on houses for our buyers, we're going to see our comps. We're going to know, well, it's not 463 or 564. It's really 533. And it's going to reflect when I go write an offer on their neighbor's house. The discord is when we're reporting it and then how things are getting appraised. That's what the frustrating part. But as a financial advisor and as somebody who bought a house this year, how are you talking people through where to put their money? How are you advising them in this ever-changing market with high rates?
Yeah. So it's a really good question and a tough one to answer because a lot of it's a case-by-case basis. One client isn't going to have the same answer as another.
Right.
However, there are themes and overlap that occur. Like, no one should be in a negative in their cash flow trying to pay a mortgage they can't afford. And with interest rates being at 8.3, it becomes a little more difficult. Now, thankfully, there's a lot of protections in place. I don't think someone's going to get approved for a loan they can't afford. Like that happened in 08.
Yeah, and luckily, I mean, it's unfortunate what happened in 08, but one thing they've done a really good job is it is hard to get a mortgage.
Yes.
It's not as easy. You can't just, there's no stated income anymore. In 08, part of the reason it happened is I could just tell you my income and there was no verification.
Good.
It would be amazing. If that was me in 08, I would have had a lot of rental properties. I probably would have failed and they probably would have all ended up getting foreclosed on because I would have never had renters.
You would have been a news article.
Yeah, I would have been a news article. I would have been on. But so
we're telling people
hard to get them.
If you have a reserve, a cash reserve, that's the main thing we're telling folks. And it's different for every person because everybody makes a different amount of income. But the average recession is about 10 months. Average. It's somewhere between 8 to 14.
Okay.
But keep a cash reserve. Don't hurt your savings to overextend yourself where the cash flow is hurt, your reserve is hurt. You want to make sure you can afford the home. And that's the two things I'd recommend just before finalizing. And
would you agree? There's always a fun stat, right? There's this big fight between renters and buyers. There's the homeowner versus the renter. And one thing I've believed, one thing that's changed my wife and I's life is the ability to, as a first-time home buyer, buy a house. We held it for 5 years and we were able to roll all of our equity over. And on paper, it says that statistically a homeowner has a net worth that's $250,000 higher than a renter.
Yeah.
Do you think that holds true?
I think it's true because people just have a hard time saving money. When they get money in their bank account from their check, it is hard to put it into an investment and save it. But you have to do that to pay your mortgage.
Don't attack me.
I'm attacking myself too.
Yeah. And I agree. It's hard. Like I treat it as just untouched. I don't treat it as real money. It's kind of there.
Yep.
But it's accessible if you had to have it.
Right. You can touch the equity in your home with a HELOC or a refinance. There's ways to tap into it, but it's not always the best idea.
Yeah. And no, I would agree. And so your first time home buyer this year, what process did you take as a financial advisor before you ever even talked to me?
So interestingly enough, I talked to my loan officer before I talked to you. I wanted to make sure I was approved, and then I did my own analysis, because nowhere in the process do you have to talk to a financial advisor. So it almost all falls on the loan officer to be the fiduciary and sometimes do two jobs at once. Yeah. So I did my own top-down analysis, my emergency funds in place. I can afford to cash flow this level of mortgage, met with the loan officer, and he introduced me to you. Yes. And then we found the perfect fit.
Yeah. And then now we're friends. And so part of outside of, we've talking about the numbers, I want to give people advice on where would you start when it comes to your home buying process? Like if you are you're a renter right now and you want to purchase a house, I'm of the belief the realtor is the last person you need to talk to. We're not entrusted to be a financial advisor. A realtor shouldn't be telling you what house you can afford or you should afford. It needs to, in my opinion, come from a financial advisor and a lender, and if you have a tax person. That's what my belief is. And I don't know if that's just what I've been taught, but I don't like diving into my clients' financials because that's not what I do. I sling doors and I love doing it. Yeah. I jokingly, outside of selling houses, I sell candy, and I say we sell smiles, right? Like with selling a house, we sell memories.
Yeah.
So if you had advice for other realtors or other renters who want to buy right now, what's their first step?
That's a great question. And I want to say the first step is figure out what your income looks like and figure out what you can afford in excess of your rent to spend monthly on a mortgage. Yeah. And once you know that number.
Do you have a recommended percentage that you went off of for yourself, or did you just immediately know as a financial advisor what to do?
Oh yeah, I guess that's true. There's a lot of knowledge that I view as common knowledge that some folks might be like, oh wow, he knows the secret handshake.
So do you think do they think they should find a financial advisor first if they're renting?
I think so. First thing, talk to a financial advisor. And I know that sounds like I'm trying to pitch myself, but we do come with a third-party unbiased view on using those funds to purchase a home. Whereas the realtor, of course, they're incentivized to sell you the home. Oh yeah. And the loan officer's incentivized to sell you the mortgage. So it's a third party who can look at the entire picture and figure out, all right, this is what actually makes sense. All incentives excluded. And I feel like you, during our process, did a great job stepping back. And
thank you. And I agree. And that's where, like, it is our job to put our clients' needs above ourselves. But a lot of times it's hard to do that in real estate or even as a mortgage provider. When you're 100% commission based, you've got bills, you have real life stuff, and you're going through. And if you unfortunately are one of the many agents who aren't doing enough business to be able to tell a client, you're not buying this thing, this is terrible, or hey, let's wait a little bit longer and go through that process. It's a hard conversation to have. And I look at financial advisors as you guys are the only ones playing the long-term game. Yeah. Right. Like your guys' potential profit for a client is based on putting them in the best financial position and then growing that position versus we're compensated on the real estate side at closing, lenders compensated at closing. And then it's our job to, nurture that and stay in touch and try to get business down the road.
Yep.
But that's not how y'all are.
No, we operate in a completely different manner. And one of the stigmas that happens with financial advising is folks think they need $1 million, $3 million before they can talk to an advisor. And that's just not true. A lot of the time, the most valuable clients are young folks who can start to save more, because the earlier you start, the more valuable you are in the end. And as a young guy myself, it is very simple and easy to maintain and influence a young person to, and the steps they make today are going to be huge in the future.
Because it's compounding.
Correct.
And so if there's a young professional, what is the easiest way outside of just instantly calling a financial advisor? But like, what are some, like, if you had to narrow it down to like 3 things, you're not even 30 yet, no kids, even if you're not married, and you're making decent money, where would you tell them to put the money today?
8 to 14 months expenses in an emergency fund. And then if they're young, a Roth IRA, assuming they don't make over the income threshold. I think it's like 220 this year.
Okay.
And then, I mean, I love real estate. If I'm being honest, it has created so many high net worth individuals. A lot of wealth has been built off of real estate investing. And whether that's because debt was really cheap over the last few years, but I feel like buying your first home or buying your first investment property is a great place to start saving towards your future.
And I agree. And when we first met and it was like, hey, Tyler, what's your financial plan? I'm like, what do you mean? I have long-term rentals. We have some commercial space in Oklahoma, and we own our personal house, and I like doing fix and flips. It's great, right? They're called like home run dollars, right? And I like them just simply because I feel like I control them, but it's not really the best long-term plan when it comes to a safe retirement or like an exit plan. And so I've been fortunate enough to meet you to where you're knocking me straight. You and Kyle broke me down on that in there. And I was like, I left not knowing anything, but
we're just balancing the liquid and illiquid investments.
Yeah.
And your stocks and your money and your cash. That's all, like, you can grab that very quickly, but your real estate, that's a process of getting the money out.
Oh yeah. Real estate's not liquid. It's only liquid if you give it away.
Right.
And then you're just leaving money on the table.
And assuming you don't live there, then there's the way real estate's gone, a big capital gain, because avoiding taxes is the other side of this picture.
Oh yeah, the tax burden is insane. I was told by a buddy of mine a few years ago that he was like, Tyler, your number one expense in life is going to be your tax bill. Your tax burden will be the most expensive thing you spend a year. More than your house, more than your cars, more everything. And I'm like, there's no way. 2 years later, last 2 years, I've spent more on taxes than I have on any other expense combined. And it's partially, it's like, cool, you do well, you pay. But at the same time, through the correct financial advising and the right strategies, that tax burden can be way lower.
Oh, yeah. I mean, I'm a firm believer that people should pay their taxes, just not a single penny more than what they need to.
Yeah, I agree. And that's where your guys' strategies are just blew my mind. And I'm excited to work with you guys. But when it comes to other people wanting to work with you, they've made it through this 22 minutes of video. Where can they find you? Who do you want to work with? And who do you guys serve? Like, who do y'all show up best for?
Amazing question. So we target 2 specific groups. It's going to be your real estate investors and it's going to be your business owners. That's really where Bluegrass shines. But the first step, I think, is to check out our website, because if I've been convincing at all that I am a decent advisor, it's not really great if I can't back it up. So the first thing you should do is check out our website. I'm pretty sure it's www.bluegrasslegacygroup.com. Learn a little bit more about us, myself, Kyle, and the team, and we would love to set an introduction meeting.
Yeah, that's good. And I mean, they're going to be doing my stuff, and it's not even about the return for me. It's about the people. I want to do business with people I know, like, and trust. Y'all have embraced me. You guys have been more than awesome. And so I just want to thank you for jumping on here, breaking out like what these market reports and numbers actually look like, how the cover of what we're all looking at is not the real story.
Yeah.
And I just, I appreciate your time, and go hit them up, because you're going to not find a better person for your finances.
And likewise, if you guys need a realtor, this is your man right here.
We got a good team, and I'm fortunate to sling doors. Have a good
and
one.
candy.
Yeah, and candy.
But especially smiles.
But yeah, I would much rather sell memories and smiles than houses and candy. So, but appreciate y'all.
Yeah, take care.